Here are the top 3 reasons you might want to consider structuring your mortgage for tax efficiency. What I'm going to show you today is going to help you improve your cash flow by paying less tax, reduce your debt by paying off your mortgage sooner, and accelerate your wealth building efforts by reinvesting the benefits. Let's pretend that Jim and Lisa Smith own their home worth $500,000. They're in a 39% marginal tax bracket and have a mortgage of $250,000, which they'll pay off in 25 years at an average rate of 4.5%. And they have $150,000 in available equity, which can be used to set up their cash flow asset. They'll get to mortgage freedom in 14 and a half years. Mortgage freedom is the point when they could sell their investment assets, pay off all the loans, and own their house outright, 1.5 years sooner than their current mortgage plan. Over the life of their mortgage, they will accumulate $98,000 in tax refunds, which are applied back to the plan as extra mortgage payments and subsequently reinvested into the wealth portfolio. And after mortgage freedom, they'll essentially have no more monthly mortgage payments to make for 10 and a half years, which amounts to a future savings of $172,000. There's no growth or interest associated with these savings. It's simply their mortgage payment times 12 months times 10 and a half years. Another way to look at this is an apples-to-apples comparison. Under their current plan, Jim and Lisa are committed to making their mortgage payment for 25 years. Assuming a 6% annual rate of return in the wealth portfolio, they will not only have paid off their mortgage, but they'll also have accumulated additional wealth of more than $384,000. And remember, these benefits were achieved with no additional cash from their own pocket. The plan is entirely self-funding. Simply by making their regular mortgage payments, and by virtue of being in a better mortgage plan, they were able to pay off their debt years ahead of schedule, improve their cash flow by paying less tax, and increase their wealth by reinvesting the financial benefits. If you're wondering if this plan is right for you, it is for AAA borrowers, and you have to have at least 20% equity in your property to consider setting up the plan. This is a minimum requirement whether you're purchasing or refinancing,